Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a huge welcome to our journey and to the Equity Mates Investing Podcast. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We're about to be joined in the studio by McLean, who is a portfolio manager over at Fidelity. He manages the Australian High Conviction Active ETF.
Yeah.
And we're going to be talking all things Aussie stocks today.
People often lament, complain about the fact that so much of our index is made up of the big banks and big miners. So today we're going to ask Casey to prove us wrong. He's going to bring a couple of companies that are in the portfolio, as well as explore the opportunities that exist here in Australia.
Yeah, big challenge for Casey. And we're doing this episode with thanks to Fidelity, and we're doing it in support of their launch of their range of active ETFs, of which this Australian High Conviction ETF is one of them, alongside India, global small and mid caps, and Asia. The range of ETFs is backed by Fidelity's 20 years of local expertise and insights from 400 investment experts worldwide. So if you want to make your smart investment decisions even smarter, and if you're looking for more information and to read the PDS and TMD, head to fidelity.com.au.
Nice. Well, without further ado, let's go to Casey. So Casey, welcome to Equity Mates.
Thanks, Bryce. Thanks, Ren. Great to be here.
So you're the portfolio manager of Fidelity's Australian High Conviction Active ETF. So we want to start with your investment approach. Can you define your investment philosophy for us?
The Fidelity Australian High Conviction Fund, it's a concentrated portfolio of our highest conviction, best ideas. And really we're looking to outperform the market over the medium term. And the way we sort of implement that stock selection is through broadly a GARP philosophy, growth at reasonable price. But at the same time, core belief is that the cornerstone of good investment performance is loss avoidance. So we have really intense focus on risk management at the same time. So putting this into action, the way we do it, the first thing we think about is not what stocks we want to own, but what stocks we don't want to own. And so if we look back historically, we've figured out what are companies that lead to the biggest risk of capital loss and the ones that underperform the market over the longer term. And we look at factors like returns, leverage, cash flow, equity raisings, earnings certainty and the like. And so once we've determined whether a company meets our sort of minimum quality bar, we're not trying to buy the highest quality companies in the market, just avoid those lowest qualities. That's where we sort of bring in the GARP philosophy. And to me, GARP is kind of an interplay. It's a trade-off between the growth and the valuation side of that equation. So on the growth side, we're looking for companies that are in either a medium-term earnings growth cycle, they have strong growth over the medium term in their earnings, or cyclical companies that are in or approaching an earnings up cycle. And then on the valuation side, we're looking for a reasonable valuation relative to that growth profile. So we kind of see it as a spectrum, right? And it's between that growth and valuation, and it's not a one-size-fits-all. It's really dependent on which sector you're looking at. So there's some high growth sectors like the tech or healthcare, fintech. We've got much more of emphasis on the growth side of the equation in those ones, whereas at the other end of the spectrum is kind of the bond proxies, your utilities, your REITs, your telcos. There it's much more of a focus on the valuation side of the equation. So if you sort of sum it up, what we're trying to do is get the best case outcome is where we've bought a stock with a margin of safety. If our investment thesis proves correct, it's going to lead to asymmetric returns over the long term.
So there's a few different elements in that investing philosophy, and would love for you to bring it to life with some of your fund's holdings, both the GARP side, the growth at reasonable prices side, but also the loss avoidance. And if you game, maybe a stock or two that's a big Aussie stock that you said, we're cutting, we're not owning this one because of the potential for loss.
Sure. Yeah, well, the ones that don't meet that sort of quality, I don't own. So hopefully, that's the first part of avoiding those losses. But, a couple of examples to sort of illustrate the different ends of the spectrum in GARP, I think. One, a growth example is a good example is SiteMinder, who's a smaller cap software company. It was about 700 million market cap when we bought it. And for those who don't know, it's a channel management software for hotels. And the value proposition for hotels is that it connects them up to the hundreds of online booking sites globally, which means they can manage their inventory of rooms and prices. So effectively they're able to maximise their revenue by getting it out to more people and at the right price. And it also reduces their costs because you don't have to do the manual work, on spreadsheets, updating different websites all the time. So, this is a company we think can grow their earnings, their top line anyway, at 30% sort of compound. And it's really about signing up more hotels. They've got 42,000 at the moment, but they say there's still over 500,000 that are still using manual processes.
Jeez. Wow.
Yeah, so their biggest competitor is a spreadsheet. Yeah. And it's getting these small hotels. They're not looking at the Hiltons or Marriotts of the world. It's the ones that have smaller, maybe single property sites or one or two hotels in a chain, and getting them on board. So that's the first leg of the growth, and getting more hotels on their software. The second is increasing the ARPU, the average revenue per user, and that's really about getting the hotels to adopt more products and rolling out more products into the suite and the software. So. They've been doing that, gradually, and using their data. They've got a really rich data set. They did, I think, 115 million bookings last year. Wow. And using that, they've developed things like transactions and payments products. They give market intelligence to the hotels, a rate optimization. So, we've got State of Origin tomorrow night. Yeah, so it's a State of Origin in town. This is what the other hotels are doing. Yeah, up your prices by this.
I've got to put my hand up and say I've looked at hotels in Melbourne for the AFL Grand Final weekend, and they are
Sydney Swans over here.
Certainly optimising their inventory based on events going on that weekend.
Yeah. I mean, those events are pretty easy to optimise, but it's other things.
Triple your price.
They get more intelligent as they go and find out what other hotels are doing, and they optimise your rates like that as well. So, the two of those combined mean they can sort of grow their revenue at that 30% compound, and they've just hit break even. So their earnings is going to grow even quicker than that. So the stock, it trades on about 5.5 times EV to sales. And if you look at other peer software companies that are growing at that 30% rate or hitting the rule of 40 for software companies, which I think SiteMinder can hit in the next few years, they trade at even higher multiples than that. So I think, with their growth profile and that valuation, that's a good sort of trade-off there. So that's kind of like the growth end of the spectrum. The value end of the spectrum, I'd sort of highlight a stock called Ventia, which is slightly larger cap. It's about 1.8 billion market cap when we bought into it. A lot of people probably don't know this one as well. It's only a reasonably new IPO. It was about 2 or 3 years listed. And they're a maintenance services business where companies and the government outsources maintenance to them in things like telcos, utilities, transport, defence bases and the like. And it is a growing industry. The government's outsourcing more every year, and the TAM is sort of growing around 6 or 7%. But Ventia is growing quicker than that. They're taking share given they have a national presence and the best risk management of their projects as well. So they're able to sort of grow earnings and revenue around that sort of high single-digit, low double-digit type growth rate. But, the beauty of that model, it's not the highest growth that you can get in the market, but the beauty of the model is the amount of earnings visibility and earnings certainty you get. Because contracts it's over 95% of their contracts have some form of cost pass-through, like a schedule of rates where you're charged X amount of dollars to, fix this telco network or repair a tank on a defence base or whatever it is. So if the costs go up, the schedule rates go up and they can pass it through. So it means you don't have the big margin misses or impairments that some of their other peers have pretty frequently, actually. So when we bought into the stock, it was trading on about a 6-7% dividend yield. So we're getting around mid, even high teens sort of total return from the earnings growth plus the dividend yield. And we were able to get into the stock around 10, 11 times PE, which is much cheaper than peers, because at the time there was a big overhang on the stock that 65% of the shares were owned by two major shareholders who were looking to sell down, Apollo, the PE firm, and CIMIC, who was the former owner of the company. And as they sold down, in block trades, we were able to get in, get a good cheap price, and stock's re-rated a bit since then. It trades sort of about 15 times earnings now because it has delivered. It's met and beat all their prospectus forecasts. Trades on sort of about 15 times earnings now, but that's still a discount to the market and some of their peers. And if I look at it, it's got good earnings growth, much better returns than the peers, and much better earnings visibility. So still fits pretty neatly in that sort of GARP framework as well.
Nice one.
So they're two very different stocks, but it displays that spectrum, I think, of stocks we can buy.
Many of your top 10 holdings are in the ASX 20. You've got CSL, BHP and CBA. Now, given the weighting that they have in the index itself, why should we consider an active Australian fund? And I guess looking at GARP, is there actually any growth left in those big names?
Yeah, no, I think that's a very fair question. And you're right, our largest holdings are the large cap stocks. And that's somewhat down to liquidity and risk management reasons as well. But what I'd say is look outside the top 5 or top 10 holdings in the fund, because it is a broad cap fund. We can go anywhere from the largest stocks in the market all the way down to small caps. And like you say, we do hold BHP, $220 billion market cap. But we also hold a stock that's 300 million market cap, and we're one of the few sort of institutional investors in a stock like that as well. And I think if you sort of look at the portfolio in its entirety, we have almost half of the portfolio in stocks with a market cap of 5 billion or less, so mid and small caps. And the active money, which indication of how different we are to the index, it's around about 60%. And to me, that's the sweet spot where you still are taking enough risk to get a return that can beat the market, but at the same time, it's not so much risk that there's big swings and roundabouts. So risk management is tightly sort of held as well. So we think it's the right amount of big and small, and overall, I think a lot of the alpha opportunities will come in those mid and small cap names that we do hold in the portfolio.
So I guess with the ASX 20 available, you've chosen CSL, BHP, CBA. Like, why those versus any of the other big names? Yeah,
well, I mean, is there any growth left in these names? I think it's a fair question, right? And you take CSL, which is our biggest position, but more importantly, our biggest bet as well, our biggest active position in the portfolio. And I think there is a great growth potential in a stock like CSL, regardless of its size. If you look over history, they've been able to compound their earnings at 20% over the last 30 years. And that hasn't really changed. So I think over the medium term, they'll be able to compound it at mid-teens, high teens going forward as well. So in the next few years, it's really going to be driven by their core business, the bearing plasma business, which has pretty good momentum at the moment. Now they're getting better volumes through increased collections, and it is a scale game. Incremental volumes are a big benefit to the bottom line. But on top of that, they're getting yield improvements as well, so able to get more plasma per patient and more products out of that plasma, because they're rolling out a new bed called Rika by a Japanese company, Terumo, which is exclusive to them. And that means there's less time on the bed for the patient, so they can have more patients collecting. Much better patient experience as well, so you're going to get repeat donors as well. And they've just had approved by the FDA something called an individualised nomogram, which means that they go in, they assess the patient based on their height, their weight and their red blood cell counts, and that can determine how much plasma they can take from that patient, whereas before it was just a fixed amount regardless. And so now you can optimise the amount of plasma that a person is able to donate, and that alone can lead to a 10% improvement in yield. And again, these things flow through to the bottom line. And then, on top of that, their margins are improving because donor fees are coming down, the amount they need to pay to donors in the US to do it, because really their competitors are in a bit of financial stress, Grifols in particular, which is very highly leveraged. So I think it's a pretty good space to be in. I think that bearing business has a really good runway, and it's coming at a time when V4, which is a recent acquisition of theirs, is not really performing. It's got a period of weak growth because there's generics coming into that market. But I think over the long term, it can still sort of grow at double digits as well. And then on top of that, they have a pipeline of new drugs, all at various stages of coming to market. And not all of them are going to be successes. They had a failure recently with CSL 112, which is for heart attacks. But they do have other good candidates, one like garadacimab, which is for HAE treatment, which is actually a new product which actually cannibalises one of their existing, HiGarda. And that's a common sort of strategy that they have, that they are willing to disrupt their own products, because if they don't do it, someone else will, and they'll lose the whole market. So I kind of look at that stock and go, well, it's going to compound at mid-teens for the long term. I'm paying about 25 times PE in FY26. You compare that to some of the other big cap healthcare names like Cochlear. That's doing low double-digit sort of earnings growth, trades on 43 times. And then ResMed, which earnings outlook is pretty uncertain given the impact of GLP-1s and how much that's going to eat into their addressable market, and that's trading on 20 times. So CSL is, again, it's kind of that sweet spot for me in terms of growth, valuation and the certainty of the earnings there as well.
Well, Casey, look, I appreciate how considered and thoughtfully you answered Bryce's question. I think an alternative answer you could have given is CSL's up, 20% in the last 12 months? And I just had a look at the big four banks and how they've gone the year to date. CBA up 17%, NAB up 21%, ANZ up 15%, Westpac up 22%. So to answer Bryce's question, yes, there is growth if you know where to look.
Yeah, the banks have done amazingly well, actually. Yeah, much better than expected, really.
When we look at the big four banks, so much of, I guess, their fortunes are tied to overall macro factors.
Definitely.
Interest rates here in Australia, interest rates differentials will sort of be a big story for the second half of the year. For the broader economy, the health of the consumer, like all of these things are so important when we're looking at the big caps and the big four banks. So when you're putting your active investor lens and looking at those companies, how are you assessing Australia at the moment, the macro health, and are you making any investment decisions, either including stocks or excluding stocks on the back of that?
Yeah, I mean, we are bottom-up investors, but genuinely bottom-up and then go all the way to the macro and do have a view on the macro. But I think, in addition to doing all this sort of standard stuff everyone does, talking to economists and the like, I think really the best way to assess the health of the economy and more importantly, get actionable investment ideas out of it is meeting people, being at the coalface, talking to CEOs, CFOs, government officials, and that's the best way to get a read on the economy. And yeah, one of the strengths of Fidelity is we have 400 investment professionals dotted all around the world. And one of my favourite statistics is we conduct 20,000 meetings annually, which is one every 8 minutes.
Wow.
Yeah, and it's really this global view that you can, that's how you generate these unique insights. And we're able to distill that huge amount of information. We do a monthly analyst survey as well, where we poll the analysts and ask them what the companies in their coverage, what they're telling them in terms of things like management sentiment, the outlook for the industry, leading indicators, how costs are trending as well. And you can break it down by industry, geography, and over time it's a really valuable way to distill the macro down into a few sort of metrics as well.
You guys could make some serious content out of that.
I was just thinking that.
My mind
Flick
is
us the report.
Yeah, you want us to run your
we'll do some
content
stuff
team?
with it. Jeez.
So I guess how do you, distilling all of that into the most annoying question in finance, where to next for the overall economy? Any view?
Yeah, well, I mean, for Australia, anyway, I think our long-held view was Australia wouldn't have a recession. We're still in that view, and I think the probability of recession is coming down. But what looks pretty clear is that growth is slowing and inflation is sticky, and the two of them are inherently linked. And if you think about inflation, what I kind of see is a three-speed economy within the inflation. So firstly, you've got the discretionary goods, the clothing, the household goods, recreation. Inflation's peaked there quite a while ago. It's trended down. It's back to about zero. That's good news. The bad news is it's only 25% of the CPI basket. Then the second category you have is the essential goods, your food and beverage, alcohol, tobacco. And there you're seeing inflation is flattening out, moderating a bit, but still above the RBA's target band. So not too bad moderating, but again, that's only another quarter of the CPI basket. And then the third category are the essential services. That's things like transport, insurance, housing, and the like. And here on these ones, you're seeing inflation's really high and even trending higher. And the problem is that's 50%. That's half of the CPI basket. And what's really driving that is wages. I think the number one input into services is wages, and wage growth is really high. And I think we've entered into a wage price spiral in Australia, and much different to somewhere like the US, where that is trending down. And I think the key difference is labour mobility. If you look at the quit rate in Australia, the amount of people who are voluntarily leaving their job, it's a third the level it is in the US. There's far higher labour mobility and people moving around. So I think that service element is largely sort of entrenched and going to be sticky, higher for longer. And that means I think rates are higher for longer. And the key area of the economy that's going to suffer is consumption, I think. But I mean, interest rates are one factor for the consumer, but they're facing, I think, a lot of headwinds. In fact, many of the tailwinds that we've seen over the last 2 years or so that led to this sort of remarkable, resilient consumer over this period, those tailwinds are switching to headwinds. So if you think about labour force, we've had job ads. The number of job openings have been declining for 16 months, and in June was down 17.6% year on year. If you look historically, whenever it's hit that level, we've seen declines in absolute employment, the number of people employed, and with population growth, etc. That's going to lead to a rise in unemployment. There's a bit of a lag, more than normal, I think, but that's going to come through. And the companies we speak to, they're all saying it's far easier to hire people now. And I think a lot of them are still hoarding labour. They might have excess labour now, but they're wary of what happened in COVID. But those things can change very quickly, and they can lead to job cuts going forward as well. The other one is the savings buffers that everyone built up during COVID. Government was giving out a lot of money. That's been largely depleted, and you can see that in excess mortgage repayments. They're now at trough levels, and savings rate has come all the way back down and below the pre-COVID level now as well. That's the economy as a whole, but even more important is the distribution of that savings. And there's CBA has some great data where they break down the growth in savings balances by different age cohorts. And it shows that it's only the people over 55 years old that are seeing their savings balances still grow. And the younger you get, the quicker the decline. And that's having a direct proportional impact on spending. And in fact, youngest age groups are cutting their spending. And then just, I think the final tailwind that turns to a headwind is migration. it's going to be cut. Both parties are talking about cutting it. It could even be an election issue on how low they go in terms of cutting migration. And new migrants are reasonably big spenders as they set up their new home, buy TVs and cars and the like. So that could turn to a bit of a headwind as well. So I think, the consumer is under pressure, and the analogy, we like to talk about is it's like a rubber band. The household budget's been stretched really tight, and at the moment they're managing. It hasn't snapped yet, but the longer it holds at these extreme levels, it's like rubber band out in the sun. It's slowly degrading, and eventually it is going to snap. So the longer these cost pressures stay in there, the weaker the consumer will get.
Well, I mean, that is what interest rates are meant to do. It's just
exactly
taking a while. Before we move to a couple of stocks, we just want to touch on M&A here in Australia. We saw a bit of an uptick towards the start of the year. Do you think this is going to continue? And I think, are there any names that you are looking at that are sort of ripe for a takeover?
Yeah, you're right. It has been pretty busy this year. I think it's about 41 billion worth of deals done already year to date, and some big names in there. Boral, CSR. CSR's been listed for 62 years, and up until now. And I think we're at a pretty interesting juncture for M&A because of the new M&A rules that the government has proposed. I think they're going to have a big change on the M&A landscape because they've effectively reversed the powers now, and they say the ACCC can block a transaction if they think it is going to be a significant lessening of competition without going to court. And now it is the company's burden to prove that it won't be a lessening of competition.
What was it before that? Previously,
the ACCC had to prove it was a lessening of competition. So that blocks them initially. But it also captures the creeping acquisition. So if either the acquirer or the target has done lots of small acquisitions over the previous 3 years, they take that into account. And they haven't announced it yet, but there's going to be mandatory reporting of all deals over a certain threshold. They haven't announced the threshold, but it's likely that widens the net as well. So none of these rules have come into place. It's proposed to come in the 1st of January 26. So what I think it means is that if there's a lot of these companies that have a strategy of doing roll-ups, gradually buying company after company, consolidating the market, that it could kill that strategy, and maybe
or massively accelerate that strategy.
Like 2026, let's go.
That's the other thing. The next 18 months, there could be a rush to get the deals done before the new rules come into place, or longer term, it could push them into offshore markets to do strategies like that. And generally, Australian companies haven't had a great track record in offshore M&A. We'll see if they get passed, but I think that could be a big change. And I would expect there to be quite a bit of M&A over the next 18 months. I don't know any companies specifically that are going to go. If you do, please tell me. But I think some of the sort of targets I think that could be out there are the sort of smaller tech stocks where they do have sort of unique IP, often a global addressable market, and they're often lost in the early stages. They're still loss-making. They're capital hungry. They could be ripe for takeovers. And then I think at the larger end of town, I think in some way, shape or form, there's going to be change in corporate structures for companies like Santos and Origin, who have already had a couple of goes. I don't think we've seen the end of the story in those two stocks in particular. Not sure. There's lots of ways it could play out, but we'll see. I think there's more to be told with those two.
Yeah, it'll be fascinating. It'll be an interesting year. We're also watching legacy media. We've got a vested interest in it, and something's going to change there. Channel 10's got a new parent.
New owner.
Yeah, definitely.
They're all losing money. Anyway. Now, Casey, we want to turn to a couple of stock deep dives. We asked you before you joined us today to bring two stocks that we can go a little deeper on. The two stocks are PolyNovo and Car Group, which is the new name for car sales. People are probably more familiar with. Let's start with PolyNovo, a company that certainly gets a lot of buzz in the retail investing community. But for people who are unfamiliar, let's start with what PolyNovo does, and then we'll get into some more questions about it.
Yeah, sure. Well, yeah, PolyNovo is a biotech, and they're focused on treatment of severe burns. They've got a product called NovoSorb, which is a BTM, a biodegradable temporizing matrix, and what it does, it's effectively a scaffold that turns a large wound into a series of micro wounds and effectively gives the body a scaffold to heal itself. And it has lots of advantages over the incumbent solution, which is animal-based biological products. It's much lower cost because it requires far fewer hospital visits, generally just one, whereas if you have the biologic visit, you have to have repeat follow-ups. That adds costs to the patient and the hospital. It's also much easier to handle for the doctors. It's made out of polymer, and they can shape it to the exact size. And of course, there's unlimited supply and consistency where there can be problems in the supply chain for animal-based products. But on top of that, it has better efficacy than the current products as well. It leads to less risk of infection, which it makes sense when there's animal products. There can be a high risk of infection, and that means there's less chance that you need a skin graft, and it also reduces the scarring as well. So I think it's fast sort of becoming the standard of care in the treatment of burns, and that's a technology PolyNovo developed and owns, and is well protected with a series of patents.
Is there something about Australia and this kind of technology? Because I'm just thinking, we spoke to the CEO of Aroa years ago. Is it just that there's a lot of these companies, or does Australia and New Zealand somehow have some advantage here?
Lamb.
Yeah, but also for burns, isn't it?
Yeah. It is, yeah. I think Aurora is mainly targeting trauma and diabetic foot ulcers, which is another indication, but it is similar technology. Yeah. So, I mean, it's a good question. I think there is good partnerships with research institutes in Australia, and we definitely punch above our weight in biotech and medical devices for sure. And it's good to see. I think those sort of companies are still coming to market as well and listing on the equity markets.
So when you were looking at PolyNovo, what was the moment you thought, there's something here, this company could be quite interesting?
Yeah, there was probably two things. I think it was really that the burns market is a pretty large market globally, and the second is that it was much more of a platform technology. So in burns, it's about a $1.2 billion market annually. There's something like 9 million incidences of full tissue burns as well, and PolyNovo are just at the very early stages of penetrating that. So they've got a really long runway in burns. And then on the other side, the platform technology, what I mean by that is that they got this one base technology, the BTM, but they can use it for multiple different indications. So like Aurora that we talked about, the other indications, they could go into trauma, diabetic foot ulcers, breast reconstruction, hernia, even infections like necrotizing fasciitis, which is bacteria, skin-eating bacteria. So they got options to grow in many different ways using the same core technology as well, and it's really the doctors, the key opinion leaders that are driving this change. They've taken up the adoption in burns, and they're actually using the product off-label for these indications. Hasn't been approved, but they're using them for the other indications and giving sort of feedback to the company, and that's how they're developing and getting approvals for other indications.
And so when you're building out your thesis, taking that into consideration, how big can PolyNovo get?
Yeah, it's a good question because, if you just look at trauma, it's double the size of burns. It's about a $2.4 billion market, much more fragmented because there's a huge range of trauma that they possibly treat. But if you add all these different markets on, it can be a lot bigger. But at the moment, I think that's kind of option value for the stock. the core thesis is really on the burns product rolling out. So they've had good success already. In Australia, it's 60% market share. Germany, it's about 56%. They're the market leader in the UK as well. But it's really about the US. That's the biggest market for pretty much all medical products. And they've already got into the top 400 burns hospitals, but now it's about ramping up the sales. So they're building out the sales team to do that. And then it's about entering new markets, some big markets like India, and also the rest of Europe as well that they're not in. So that's the core. Plus, they've got price that they can trigger as well. It's mainly a volume story. There is price because they're still half the price of the incumbent solutions. And then I think, then I add on the option value from going into... They've got some success in trauma. And again, it's being led by doctors who are using the products, looking for an easier way to treat these injuries other than plastic surgery or skin flaps. And so that's they've got a little bit of traction on that, but it's really a very long runway for the rest of them.
Now, it sounds good, but there's always risks when we're looking at a company like this and building a thesis. So what are those particular risks you're looking out for, and what would be a signal that the thesis is broken and you might get out?
Yeah, no, there's definitely risks. I mean, they've just hit break even again. And they do have a good balance sheet that should see them through, but it's definitely a risk. And they're also in the process of expanding capacity. All their capacity is in Melbourne, and they're expanding it fivefold, which see them able to do about 500,000 devices per year. But that in itself is a bit of a risk because you mentioned US will be their biggest market in the near future, and if Trump gets in, he's talked about a 10% tariff on all imports.
Oh, true, yeah. Got it. It's going to affect everyone. Isn't it? Yeah.
I think it's likely medical healthcare products get carved out of that. But that is a risk.
Their healthcare system's expensive enough as is.
Yeah, exactly. Yeah, you wouldn't want to be paying for increasing healthcare costs. So but it's a risk that they've got to manage. Then there's competitor products. We mentioned Aurora. There's others in burns plus the incumbents. So it is competitive market as well. The other thing is they are doing clinical trials in these other indications. If they get poor results in them, that is a risk as well. But as I say, it's about rolling out the product in burns, which is fully approved, doesn't need any or more approvals. So
to close out today, Casey, we want to move to Car Group. Can you just give us a refresher on what the company does, who they are? Yeah, sure. Yeah, well, Car Group, formerly known as carsales.com.au.
And why did they change their name?
Yeah, it's a good question. And it's core to the thesis, actually.
Okay.
So they own carsales.com.au in Australia, but really, Australian business is still good, but the thesis is really about internationalisation of the company. And all the other websites, online classifieds they own, none of them are called car sales.
True.
So they're going to Car Group. That was the main reason. But a bit of background on them, right? So car sales is the dominant platform in Australia, has about 90% of the market. They have about 1.5 to 2 times the listings of the second player, but more importantly, 25 times the number of page visits as the second player.
Wow.
So it's a dominant platform in Australia. Then on top of that, they operate in South Korea, Brazil and the US. US is just in RVs and trucks, not cars. And in all those markets, they're number one or close to it. So it's really about rolling out their strategy to international markets.
The next question we're going to ask is, what are some of those moments where you're like, there could be something here, but I think you answered it there. Just like the dominance they have in Australia, their growing presence overseas. But I guess when you look at the company today, with all of that sort of accounted for and thinking about investing in it, in 2024, what's the thesis going forward? It can't get much bigger in Australia.
No, it can't. The one thing that I thought about in this company was that global opportunity set, and especially when you compare them to the other online classifieds we have in Australia in property, REA and domain, and then jobs with Seek, I think it's the only one that's really internationalisable, because selling a car is the same the world over. You either sell it privately or trade it in. But if you think about property, buying and selling a property is very different all the world over. It's whereas vendor paid advertising, whether it's exclusive agents, whether they have auctions. I lived in Hong Kong for 10 years, and if you want to buy or rent an apartment, you find a buyer's agent, an agent who takes you around, and no properties are exclusive to anyone. You visit all of them. And then the agent who you sign with, they get the commission on that. It's very different. It means that you don't spend as much on advertising. And then if you think about jobs, right, I think it's probably somewhere in the middle, where there is some commonality, but there's also a lot of local nuances as well. Like there's often mandatory government job posting board where all jobs have to be posted on that, like in Singapore. And some economies, particularly more blue-collar economies, they have a lot of contract labour and labour firms that hire out there. So that's why I thought car was much more able to scale internationally. But it's also that pricing power. They're getting to what's next. I think the pricing power for car was really underestimated. When you think about these online classified platforms, they have a really, with the successful ones, the dominant ones have really strong two-sided network effect where they bring together both the buyer and the seller. That means that if you're an advertiser, you're not going to go the second platform, or if you do, you're going to pay less, which creates really strong barriers to entry and therefore pricing power. And I don't think there's any doubt the best pricing power is in property, because the cost is less than 1% of the cost of the house. Property prices go up over time. But I think it was underestimated in car. And that's really because they were able to implement what they call dynamic pricing, which was splitting up pricing based on the price of the car, and then introduce new ways to get pricing power, like instant offer, which is basically a digital trade-in. So I think going forward in Australia, it's about the rollout of those things. They're going to introduce new factors into dynamic pricing, like location, even the make of the model of the car, so you're able to split up pricing even more. Digital instant offer is really interesting. It's very early stages at this point, but in a perfect scenario, it means they can monetize the same transaction multiple times. So if a private seller wants to sell their car, they list it on car sales, costs them about $150. They have people come over their house, kick the tyres for a month and negotiate, and it's all too hard. So they go back to the site, do instant offer. That day they get an offer from a dealer who buys the car straight away. Costs them nothing, the private seller, but the dealer pays car sales $500. Then the dealer turns around straight away and lists it back on car sales, and then they get revenue from lead generation again.
There you go.
Yeah.
It doesn't always happen like that, but that's the perfect scenario.
Yeah,
right?
nice.
And early stages of monetizing that. And then but the really exciting point is that all the international markets they operate in, they're pretty early stages of adopting these IP that they've developed in Australia. Korea's a bit more progressed. They bought into Korea about over a decade ago and implemented a lot of those, and also had some sort of unique local strategies there, like guarantees. Like they check over the car and guarantee it's all fine as well. And when they bought Encar as a business there, it was the second player. Now it's the dominant number one in Korea.
Yeah, okay.
And now they're going to roll it out in Brazil with Web Motors, and then in the US with Trader Interactive in trucks and EVs. And these are large markets. They're 2 to 4 times the size of Australia, and at very early stages. And then the other, I think the final part is media. In Australia, but globally as well, it's sort of underappreciated part of their business because they have pretty unique and rich data set that they can give to the advertisers, which generally, auto OEMs, dealers or insurance companies, something related to auto. But they can use the data they have to target the customers based on location, what stage of the buying cycle they're at, what segment they're interested in, SUVs or small cars, and then what brands they're aware of and like as well. So they've just totally restructured that business in Australia as performing really strongly, and I think it's about rolling that one out to international markets as well.
It's a fascinating story. I guess to close it out, where do you see the risks with an investment like this? What would break the thesis? And in particular, I'm interested if you have any thoughts on any competitive business models that we might see overseas, like Carvana is the one that comes to mind.
Yeah, and you do have competitors entering Australia as well with things like similar to the digital instant offer as well. But I think the success of these things really comes down to who has the most eyeballs. Yeah. And if you can have a good offer where you're getting the most traffic through your website, they're probably going to be the win, and it's really hard for these incumbents to break into that. You've seen Cars Guide, Gumtree been trying for a long time in Australia, and no real success. So it is a risk worth monitoring, but for now I think it's generally a winner takes most type business in online classifieds. But some of the other risks, I think used car prices declining is a risk. They obviously ran up a lot during COVID, and they've been coming down since COVID. That is a risk, but with this dynamic pricing, they can offset that by changing the price brackets and in response to lowering prices as well. I think EVs are actually a risk because I guess the experience has been much worse than expected. Resale values are much lower than ICE vehicles. They're depreciating at twice the rate. And it's still pretty uncertain on what the length of life of an EV is. And obviously if it's shorter, you're going to transact that car less over its life. Yeah. But I think the real sort of existential risk is robo-taxis because the private car is utilised so little. If you can have robo-taxis replacing private cars, that is a big threat. There's none in the market now. Even when they are, it's going to take a long time to replace the whole fleet, but that is definitely a risk.
Well, good news for you there, Casey. Elon Musk came out at the back end of last week and said he was going to announce their Tesla robotaxi in August. Now it's October. I would hazard a guess that that's going to get blown out as well. But look, it's certainly a risk worth watching. And I think both companies, PolyNovo and Car Sales, fascinating ones that we'll all be keeping an eye on.
Nice. Well, Casey, that does bring us to the end of today's episode. It was in celebration of Fidelity's active ETF range. Today we were discussing the Australian High Conviction Active ETF. The ticker is FHCO. And backed by over 50 years of investment experience, Fidelity's new range of active ETFs cover India, Asia, concentrated Australian equities, and global small and mid caps. It puts the 400 investment experts that Casey you spoke about at your fingertips. So access the best of Fidelity's hand-picked investments in just one trade.
And if you're looking for more information and to read the PDS and TMD, head to fidelity.com.au.
But Casey, absolute pleasure today. Thank you for taking the time. We really do appreciate it.
Thanks very much, guys. I enjoyed it.
Thanks, Casey.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.